If you sell products online in the United States through Shopify, Amazon, Etsy, or your own website, there's one topic that can quietly destroy your profits if you ignore it: taxes. Many new e-commerce sellers think taxes are simple, just sell a product and report income once a year, but the reality is very different. In the US, e-commerce taxes involve multiple layers, including sales tax, income tax, marketplace facilitator laws, nexus rules, and reporting requirements. If you misunderstand these rules, you could end up owing thousands of dollars in penalties, even if your store is small. So in this video, I'm going to clearly explain how e-commerce taxes work in the United States, what every online seller needs to know in 2026, and how you can legally stay compliant while protecting your profits. Let's start with the first and most important concept: the difference between income tax and sales tax. Many beginners confuse these two. Income tax is the tax you pay on the profit your business earns. For example, if your online store makes $100,000 in revenue, but your expenses, such as product costs, ads, shipping, and software, total $70,000, then your taxable profit is $30,000. That profit is what you report to the IRS when filing your taxes. Sales tax, however, is completely different. Sales tax is collected from customers when they buy products, and then you send that money to the state government. In other words, sales tax is not your money. It's money you collect on behalf of the state. Now here's where it gets complicated. In the United States, there's no single nationwide sales tax. Instead, each state sets its own rules. Some states charge high sales tax, others charge none at all. For example, states like California and New York have significant sales tax rates, while states like Oregon, Montana, Delaware, and New Hampshire do not charge state sales tax. This means that depending on where your customers are located, your tax responsibilities may change. This brings us to one of the most important concepts in e-commerce taxation: nexus. Nexus simply means a connection between your business and a state that requires you to collect sales tax there. Traditionally, nexus was based on physical presence. If you had a warehouse, office, or employees in a state, you had nexus there. But after the landmark Supreme Court decision in 2018, known as the Wayfair decision, states can now require businesses to collect sales tax based on economic activity alone. This is called economic nexus. Economic nexus means that if you sell enough products into a state, you may be required to collect sales tax even if you have no physical presence there. For example, many states require sales tax collection if you exceed $100,000 in sales or 200 transactions within that state in a year. Let's say you run a Shopify store from Texas, but you sell $120,000 worth of products to customers in California. Even though you don't live there or operate there, you may now have economic nexus in California and must register to collect California sales tax. Another important rule that affects many sellers is marketplace facilitator laws. If you sell products on platforms like Amazon, Walmart Marketplace, or Etsy, these platforms often collect and remit sales tax on your behalf. For example, when you sell a product on Amazon to a customer in New York, Amazon may automatically charge the customer sales tax and send that money directly to the state. This simplifies things for sellers, but it does not mean you can ignore taxes completely. You still need to track your revenue and report income for federal and state taxes. Now let's talk about income reporting, which is another area where many online sellers get confused. In the United States, payment processors like PayPal, Stripe, and marketplaces such as Amazon issue a form called the 1099-K if your sales exceed certain thresholds. This form reports your gross transaction volume to the IRS. For example, if you processed $80,000 in payments through Stripe during the year, Stripe may issue a 1099-K showing that amount. The IRS receives the same information, so if you fail to report that income, it can trigger audits or penalties. However, remember that the number on a 1099-K is gross revenue, not profit. That means it does not include your expenses. So if your store generated $80,000 in revenue, but $50,000 went to product costs, advertising, and shipping, your actual taxable profit might be much lower. This is why good bookkeeping is essential. Keeping track of expenses allows you to reduce your taxable income legally. Speaking of deductions, there are several legitimate tax deductions available to e-commerce businesses in the United States. Advertising expenses, including Facebook ads, Google ads, and influencer marketing, are typically deductible. Software tools such as Shopify subscriptions, email marketing platforms, and accounting software can also be deducted. Shipping costs, packaging materials, website hosting, and even certain home office expenses may qualify as business deductions if used for your online store. Inventory accounting is another critical piece of the puzzle. Unlike digital businesses, e-commerce companies deal with physical products. This means you must track the cost of goods sold, often called COGS. Cost of goods sold includes the purchase price of inventory, manufacturing costs, and sometimes freight to bring products into your warehouse. These costs are deducted from your revenue to determine your gross profit. Let's look at a simple example. Suppose you sell a product online for $40. The product costs $12 to manufacture and $5 to ship from the supplier to your warehouse. That means your cost of goods sold is $17. Your gross profit before advertising and other expenses is $23. When you calculate taxes, the IRS focuses on profit, not total revenue. Another issue many online sellers face is multi-state tax registration. If your business crosses economic nexus thresholds in several states, you may need to register for sales tax permits in those states. This process involves applying with the state tax authority, collecting sales tax from customers in that state, filing periodic sales tax returns, and remitting the collected taxes. Many businesses use automation software like TaxJar or Avalara to simplify this process, because manually managing dozens of state tax rules can quickly become overwhelming. You should also understand estimated taxes. In the United States, self-employed individuals and business owners often need to pay taxes quarterly instead of waiting until the end of the year. These estimated tax payments help avoid large tax bills and potential penalties. The 4 typical deadlines are April, June, September, and January. If your e-commerce business is profitable, setting aside money for these quarterly payments can prevent serious financial stress later. Another smart strategy is separating personal and business finances. Opening a dedicated business bank account and using accounting software helps keep records clean and organized. When tax season arrives, this organization can save hours of work and reduce the risk of mistakes. Finally, it's important to mention that tax laws change frequently. States update economic nexus thresholds, reporting rules, and compliance requirements regularly. Because of this, many successful e-commerce entrepreneurs work with certified public accountants or tax professionals who specialize in online businesses. A knowledgeable CPA can often identify deductions and strategies that save far more money than their fee. So let's quickly recap the key points. First, understand the difference between income tax and sales tax. Second, learn how nexus and economic nexus determine where you must collect sales tax. Third, remember that marketplaces like Amazon may collect taxes for you, but you still need to report your income. Fourth, keep accurate records of revenue, expenses, and inventory to calculate your real profit. Fifth, consider automation tools and professional advice to manage multi-state compliance. If you treat taxes as part of your business strategy rather than an afterthought, you can protect your profits and build a more stable e-commerce company. If you found this explanation helpful and want more practical guides about online business, finance, and legal strategies for entrepreneurs in the United States, make sure to subscribe to the channel and turn on notifications so you don't miss upcoming videos. And if you know another online seller who might be confused